About the indecision candle setup. Now, most new traders learn a little bit about candlestick analysis. I'm telling you, when I offer my candlestick classes, my candlestick basic, my 3-week course again, it's packed. And everybody wants to learn all about candlestick patterns. But most of what they learn is completely useless. Now, that doesn't say candlestick charts are useless. That doesn't say candlesticks are useless. Pattern recognition is what is useless. Memorizing all the patterns of candles. The standard approach to candlestick analysis is basic pattern recognition, which fails to work in real trading. Now, you can't just jump forward to the advanced candlestick analysis without knowing some basics first. And if you don't know the basics, that's all right. I got you covered. When Forex traders first start out, they usually learn about candlesticks. Everybody wants to trade candlestick charts. They see these pretty green and red candlesticks, and they think if they see lots of red, they should be selling short. They see lots of green, they should be buying. But usually what they learn is useless. They normally see a list of candle patterns like the one I've given you. You look on your screen, there's a little box that says handouts. I've put together a very nice cheat sheet for you. It's all the top candlestick patterns, how to recognize them, what they're supposed to tell you. But the fact is, they work much better in short-term trading, fast online trading like CFD trading, Forex trading. Really, you don't have time to notice all those patterns for all of those patterns to develop. But you should know some of the basics. So if you click on that little button next to candlestick cheat sheet, you just click the download button. It's a PDF. There's nothing you have to sign up for, nothing you have to pay for, no password. It's just a PDF. And then you can download it to whatever device you're using and then move it around later because it's only available in this live class. And you'll learn about the hammer and the inverted hammer and the doji and the spinning top and the shooting star and the hanging man, the gravestone doji, the bearish spinning top. Wow, that's a lot of names, a lot of things to memorize and be able to notice. But this is not candlestick analysis. It's really pattern recognition. And for a price action trader like you and I, it's really useless. Actually, it's worse than useless. Thinking about candles as just patterns is counterproductive. It makes you a worse trader. It leads you to massive mistakes. Why? Giving a pattern a set of definitions leads to tunnel vision. When you see that specific pattern, you assume that something will happen. But that is not how candlesticks work. All candlesticks need to be assessed based on the candles around them and many other factors. So normally people say things like a spinning top means a reversal is imminent, which can be true. The definition of a spinning top, when you see one, is you're looking at a reversal pattern. However, the same pattern can also mean that a continuation is imminent. It can mean that price is temporarily stalling. It can mean a lot of different things. Thinking about candles as simply patterns is the wrong way to do things. You need to look beyond the patterns and learn to read the story of price. And candles will help us understand what price is trying to tell us. So what's the story of price? Well, every single candle in your chart is telling you a story. When you combine those candles together, you get the story of price. The foundation of my Forex trading strategy is reading and understanding the story of price. Reading and understanding the story of price is vital in Forex and CFD trading. It is vital because it allows you to answer one of the most important questions in trading. Who is in control of price? The question has three possible answers: buyers, sellers, or neither. That's all the choices that you have with anything. But being able to accurately answer this question is vital. If you're about to enter a short trade, you want to ask yourself, who's in control of price? If the answer is buyers are in control of price, then why would you be selling short? So let's break down the story of price. So if you look at the three candles that I have on the chart, it's easy to conclude that the sellers are in control. That's what we see when we see this down motion, lots of red candles. And that's a natural assumption. When we see the next step, we say buyers are in control. Now, when we look at the three red candles, and whether it's three red candles, three reds, one little green, four reds, and three, we see a movement and we see lots of red. We see lots of down action. Now, in this case, the candles all close lower than they open. They all created new lows beyond the previous candle's lows, and they all had upper wicks in comparison to the candle body. The small upper wick indicates that the buyers were unable to push price up by much. Okay, so that's telling us a story that the upper wick, the buyers were never really able to get much momentum, even though the sellers were able to pull price down. So it has a short upper wick, a small body, but then we get in this development, happens all the time in trading, but then we get a weird little candle. It has a short upper wick, a small body, and a long lower wick. This is what we call an indecision candle. But now, don't get yourself all in an uproar about it. We get indecision candles by the ton. And most of the time, there's just a little hesitant market, a little stall for a minute in the market. They don't really tell us much of anything. You sure can't make your trading decisions based on an indecision candle, or can you? Well, a lot depends on where an indecision candle actually pops up. Indecision candles occur when neither buyers or sellers can gain and maintain control of the price. They are common, but if used in the right way, they can be very powerful. So in this case, which is just the opposite of what we were looking at, we have three green candles. So like I said, it could be five candles. It could be three greens, one red, one tiny red, one green. But we have a trend. We have price moving upward. And then we get an indecision candle. This happens all the time. It's where this indecision candle forms. The only time indecision for this strategy is important to us is when it forms in a support or resistance zone. Let's go over to a real chart, a live chart, and take a look. Okay, this is the live current Euro US dollar chart. Okay. Now, I've circled for you on here. See, we had a couple candles moving up. We reached a support and resistance zone, and we got an indecision candle. Now, we had an indecision candle here. We had indecision candles all over the place. But the only time they are important to us is when they form on a support and resistance zone. So what's a support or resistance zone? Well, all of you should understand what support and resistance are. They are historical prices or levels where price in the past has hemmed and hawed. Prices reversed. We had swing lows or lots of closes in the past at a particular price. Okay. We don't have a class today on support and resistance and drawing these lines on your chart. But you also have to remember support and resistance is not a finite price because you're using your eyes to look at a level where you had lots of closes or lots of opens or swing highs and swing lows in the past. And because we're trading today, in today's market, 4 digits over to the right. Okay. We're not drawing an exact line on the chart. So we need to look at these as zones. Okay. A little bit of leeway. Because you say my support or my resistance level is at 119,762.1, and you're waiting for something to happen at 119,761. Well, the odds of it happening exactly there is going to be very rare. But if you said your support and resistance zone was between 161, 174 and 161, 165, that means you're giving yourself 9 pips all the way to the right to determine if the indecision candle actually formed directly on the support or the resistance zone. Now, what we have here is the only time in this strategy that this is important, because the strategy has no value. It is of no use to you, this setup, except when it happens here. So when it doesn't happen on your support and resistance area, it could be a value. It could be a valid trade of some sort. It could be part of a whole different strategy. But this setup is only based on 4 points. 1, that price has been moving in a specific direction. 2, that an indecision candle formed directly on your support or your resistance zone. Okay. That's only step number 2. But unless this has occurred, you can't go on to step number 3. So let's go back to my PowerPoint. So we have our price movement in a defined, now this is a trend, not a trend line. And it doesn't matter whether it's the last 3 candles, the last 9 candles, the last 12 candles. Okay. It needs to have a very specific move. Okay. Then you need to get, when the market is moving up and it is a strong movement up, that this indecision candle forms, and this indecision candle forms on that support or resistance zone. So when price hits resistance, we get an indecision candle forming. So let's break down that candle or that story so you understand why it indicates indecision. So a large upper wick shows that buyers tried to continue the bullish trend but failed. Sellers took control of price and pushed it down, even though it was just a wee little bit. The small bearish body shows that the sellers were unable to close lower than the open. This is significant because in the 3 candles before, the price consistently closed higher than open. This shows us the buyers are losing their power. So the buyers have the momentum to push trade up. Now, when price is moving up, there's a lot of pressure. Buyers are buying, buyers are buying. They're jumping in, they're jumping in. When they start to lose their strength, we need to be aware of that. Now, that doesn't mean that the overall price trend over the next 6 hours or the next 2 days won't continue up. Okay. What it's telling you, okay, remember, price moves in a push, ease, push, ease, push, ease, push, ease, push, ease. Okay. This is a good developed trend. Okay, this is a problem. You have a beautiful trend line. This would make a very nice longer term trade. All this is quite possible. The fact is, if we were to see price moving down, 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 okay, we're looking at a very small segment in reality. Then we get on the support level, indecision. Well, that would allow us to get in that trade in a nice up movement there. But again, here, when price is moving up, 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 up here, it's still going to reach some point that is going to take its trough from its peaks and its valleys. It's going to have its retracement. Okay. When you get that and you see price, buyers were strong, 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 got some indecision, well, that's a good time that you could then enter and take advantage of this move down. Again, you could get in here, but if you're not a counter trend trader, it's going to give you that same information when you can trade that wave going up. So altogether, this indecision candle forming right after a strong bullish candle suggests that the power has shifted from a decidedly bullish market to a decidedly bearish market, even if these are 15-minute candles. Okay, so we were in a very bullish segment and we're going to continue up. But right now, over the last hour, it's very bullish. In this 15-minute segment, those bulls lost their momentum. That's not saying the price is going to come here, hit here, come down to its retracement, and then move right back up. What it's telling you is right now, we might have an opportunity for a short-term sell opportunity. But there's more than this. This is just step one and step two. But there's one more thing we need to look at. The indecision candle is forming on top of the resistance. So let's go back and look at the chart again. So price stalls and we get indecision forming on top of the area. This tells us the sell area is working. When price pushed into that area, sell orders triggered and buyers could no longer continue up. That is what the story of price is for this particular chart, for this segment of time. And if the story gives us this story gives us a nice little price action trade setup. So in this case, okay, here we had a nice little price action setup. Down, 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 down. Nice little setup. And we could have gone in and rode the market at least till that point. Now here, we pushed all the way up, but we didn't get indecision. Okay, we don't have a really defined indecision candle here at support. So what happened was price eased back down. Now we got an indecision candle, but you see it's not on our support and resistance area, so it has no meaning to us. So we'll wait for price to move back up into that area. But see, again, here we had beautiful formation. When you get that, okay, we can start combining that into a trading decision. So let me just clean up this chart a little bit here. Now, again, this is another view of that same euro US dollar. And again, we have not moved into that resistance area again. So we'll keep a close eye on that price movement. So right now, before we go on to step 3 and 4, I'm going to show you another little way. I'm going to show you a little presentation on how you can use candles to understand the simple price action, how you can use candles to interpret the story of price. And then we'll come back and we'll add on a few more steps to make this decision and find out how to make this trade. So now you have some general idea of what to look for, what key levels to look for, and what to be aware of when you're analyzing this. So it's not so simplistic as just simply looking for this little indecision candle to pop up in the middle of your trading. So how do we spot a reversal trade? Reversals occur quite often, but if you do not know what to look for, you cannot trade them. Reversals are one of the strongest price action setups and one of the easiest to trade. So what are you looking for? A reversal trade comes in three parts: the preceding trend, the indecision candle, and then the reversal trend. So the preceding trend, we've talked about that. The preceding trend is a strong move by the bulls or the bears heading into a level of support or resistance, or a key price level, a key level, a core level, whatever you want to call them. The preceding trend is in this case, a very strong bearish, or the other one, very strong. This is a very strong bullish, and the bulls were in control. So when a preceding trend can be formed by as little as one candle. Now, the rules say that, but I don't believe in it. I say a preceding trend must at least be 3 candles. So preceding trends are simple. If you see a strong move heading into an area of support or resistance, you can consider it a preceding trend. Then we get the indecision candle. A reversal setup will have 1 to 3 indecision candles. The indecision candles need to form on top or near the area of support or resistance, like we saw on my live charts. So here, in this case, we had 2 indecision candles. In this case here, we had 1 indecision candle. Okay. But they need to appear on the level of support or resistance, and they need to appear after a preceding trend. If indecision does not form on or near the area of support or resistance, it's not a valid reversal setup. Why does it need to be on the areas of support or resistance? Well, indecision candle in a bullish preceding trend indicates that buyers are possibly losing control and that sellers may be gaining. However, an indecision candle does not indicate that price will reverse with any degree of certainty. An indecision candle only indicates one thing: indecision. So you cannot take a trade based solely on indecision. Over here, you can see all of these indecision candles forming in a natural movement of price. So you need the indecision candle to be directly on your level of support or resistance. And then we need the reversal trend. The reversal trend is the third and most important part of the reversal setup. This is where we make our profit. After a preceding trend stalls at support and indecision forms, you often see a reversal trend. The image below shows a bearish reversal trend forming after indecision on a resistance. So in other words, in the background we see here, the same chart we've been looking at, price moving up, indecision candle. Now remember, indecision candle does not need to be the opposite color of the previous move. What's an indecision candle? Small body, small lower wick, large upper wick. This is then our reversal candle setup. Now remember, we're not saying that the price trend, the overall movement of price, is about to reverse. We're not saying if price has been in a longer term, or say an uptrend for the last 2 days, we're not saying that uptrend is over. We're looking for a very small time frame. We're looking at the next 4 candles, the next 3 candles. We're just looking to make profit on this short-term trade. So in this case, we saw the transition of power from a bullish preceding trend to a bearish reversal trend separated by a stall of resistance. So where do you enter the trade, though? You know what the reversal trade looks like. You know that you need to enter after indecision and before the reversal trend. This is the problem. You got to be able to trust these. And one of the reasons it has to form on support or resistance is that is your key, because you cannot wait for the fully completed next reversal candle. Because if you do, sometimes it's eaten up all of your profit. So my trading strategy is built on reversal trading. It has now expanded beyond just reversals, but reversal trading is where it all started. Entering trades does not need to be difficult. Remember, my goal is to keep things simple. So it's about getting in at the right time. So as I explained, that a reversal comes in three parts: the preceding trend, the indecision candle, and then the reversal trend. You need to enter the reversal trade after part two, the indecision candle closes. When you confirm you have an indecision candle and that indecision candle has completed and formed on the support and resistance area, you need to be ready to enter a trade. Okay. Because you want to enter it before the reversal trend completely takes off. Because obviously, if you enter after the reversal trend takes off, it's too late. So what you have to do is you have to study these long enough and believe in the trade enough that you're willing to take that risk, but you set your stop loss very, very, very close. So if it ends up not being a good reversal trend, you get out of that trade with a very tiny loss. Statistically, you will make more money than you will lose. You need to be able to make sure you do not enter too early, as you could be entering a false setup. So, like in this case, what happened? Indecision candle on the resistance zone. This is the candle that entered, but what happened? Prices continued on down. Big false setup. But if you would have set your stop loss right below that area of support and resistance, right here, you would have gotten stopped out, taken your small loss and been able to lick your lips. And you want to enter that trade here. So failed trades happen. There's nothing you can do about them. But getting in at the right time lowers your percentage of failed trades. Many people wait for a candle close to get in. But I have tested this thoroughly, and waiting for closes gets you in too late. This means you missed out on a lot of potential profit, which is obviously not good. The key to reversal trading, or any trade for that matter, is getting it at the right time. So how do you do that? I have tested countless entries over the last 15 years, and I have found three awesome entry strategies: either entering on the new high or low, on the retracement entry, or on a distance entry. When indecision forms on an area of support or resistance, you can use the high and the low of that indecision candle. In other words, this is your indecision candle. You can't do anything until it's formed. You would set your entry point right below the low of that indecision candle, or the length of the bottom wick. You would set your stop loss right at the top of that top wick. Now, if this ends up faking you out, in most cases, what will end up happening is you would have never entered the trade. The system would have never generated a trade for you because it never came back down to where your entry is. If it happened to fall down and then turn around and come back up, you would have gotten out with a very small loss. So we set our entry a few pips below the low of the indecision candle and our stop loss a few pips above the highest point of the candle. In trading, highs and lows are very important. If a new low is created from resistance, it indicates sellers have taken control of price, which means we want to be short. Our stop loss sits above the high, as the break of the high would indicate buyers have gained control of price. For long trades, you set your entry just in the reverse. And where to set your targets. Targets are also very easy. You need to make sure your target comes before the next major barrier, like the next area of support or resistance. So if you enter a long reversal from support, make sure your target is set right before the next resistance area, because you have to calculate your risk-reward ratio before even deciding to enter this trade. If you target based on your entry and where you put your stop losses beyond the target price you would be able to set, because it's beyond the next level of importance, you just can't make that trade. So in trading, a lot of people tend to overcomplicate simple concepts. Sure, some of the concepts in trading are not the sort of thing you would know intuitively, but many things are easy. You just have to know what to look for. So this is a simple idea of how to enter a trade, and you'll find if you do this often enough, do it well enough, that your losers will be small losers, your winners will be nice profitable trades. So trading is all about moving the odds in your favor and having more successful trades or more losing trades, and managing your risk so that when a trade doesn't do what you thought, you have a very small loss, so that your profits on the next trade leave you profit as well as cover your loss from your preceding trades. So thank you very much. Now, if you do have any questions, if you go to www.alvexo.com and either send them an email or click on their live chat button and ask away, and they'll be glad to answer it, or click on their Trading Education Center and you'll find videos, seminars, webinars, all the material that you can learn independently to learn to implement this strategy. And the last key kicker here is, remember, volume, 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 volume. Volume is always your final indication. When you make a trading decision or you're ready to make a decision, if volume doesn't support your decision, like if you're going to sell short